Welcome everyone, and thanks for joining us today. Today's webinar is entitled, What Every Financial Planner Needs to Know About the Hidden Advantages of Life Insurance. This webinar will last approximately 15 minutes, and at the end you will be given an opportunity to receive supporting materials by email free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Sugis. Linus worked for a Chicago-based insurance company as Director of Advanced Sales and Chief Marketing Officer. Linus also writes the publication Think About It, founded by life insurance industry guru Steve Limberg. He started and sold an estate planning law practice in Franklin, Tennessee, and his books are currently available on Amazon. Linus will draw on his legal, life insurance, and practical experience for today's webinar, and here he is.
Thanks very much, Jen. I'm going to spend about 15 minutes talking about the advantages of permanent life insurance. Some of them are perhaps obvious, some a little less obvious. The information that I'm going to cover today has been gleaned from years of taking calls from life insurance professionals, answering some of their most asked questions. And really the purpose is to remind everybody on the call about the reasons that we sell the product that we sell and why it's so versatile and how it helps solve so many problems for our clients. The life insurance, permanent life insurance as a tool can help our clients meet so many of their planning objectives. So here's what we're going to talk about today. We're going to talk about the hidden advantages of life insurance. It's got tax-deferred cash value growth. It's got tax-advantaged access to cash during lifetime. There are some creditor protection characteristics. We'll talk in some detail about that. It's FAFSA, college savings, college scholarship advantaged, financial aid advantaged. It's got tax-advantaged rider benefits for many riders. There's an acceleration of death proceeds that are available, and that is tax-advantaged as well. And you've got the ability to leverage and configure life insurance in such a way that it is estate tax free as well. So we're going to talk about each one of those in just a little bit of detail today, touching on some of the source material for the advantages. So first of all, the tax-deferred cash value growth is one thing that perhaps we don't emphasize enough. Income taxation of life insurance policies during lifetime is governed by Revenue Code Section 72, which tells us the taxation is tied to distributions rather than accumulation. Now, I'm not going to go through Section 72 in a lot of detail, frankly, because it's hard to follow. But the bottom line is that the U.S. Treasury Department, the same folks that give us the Internal Revenue Service, has this to say about permanent life insurance. And what they say is life insurance contracts have a savings component, and the accumulated income earned is referred to as the inside buildup. The income on other types of investments is taxed along the way, but the inside buildup is only taxed when it's distributed. And if it's distributed as a death benefit, it's never subject to income tax. And so the Treasury Department has recognized that life insurance has that advantage compared to other investments. And so I think we need to be unafraid to tout the same advantage, because the IRS's boss also touts how good it is. There is tax-advantaged access to permanent life insurance's cash value during lifetime. What's the source of the idea that withdrawals on a non-MEC life insurance policy, withdrawals are a tax-free return of basis first? Well, it's governed by Code Section 72E, which combined with some other code sections say that life insurance withdrawals are recovery of basis first. And then loans are not treated as taxable distributions at all on a non-MEC. There's a special rule from MEC that says that loans are taxable distributions, but for a non-MEC, loans aren't treated as a taxable distribution at all as long as the contract stays in force. And so the folks at INSMARC have said in the past that there are 3 ways to get money out of a permanent life insurance policy. One of them's stupid, one of them's sad, and the other is smart. The stupid way is to surrender the whole contract. You lose the life insurance protection, you pay income tax on any gain in the cash value. So that's not necessarily a smart way to access the cash. The sad way is to die. We'll talk about the income tax-free nature of the death benefit of life insurance in a few minutes, but if people had to die in order to complete their financial plans, well, we wouldn't get a lot of takers on that. And then finally, the smart way to access money during lifetime is to take withdrawals up to basis. Those are tax-free return of basis. And then loans thereafter. Loans, as long as the contract stays in force, are not taxed at all. And so as long as we keep an eye on the life insurance policy and manage it properly, the insured owner of the contract will never pay income taxes on the distributions that are taken during lifetime. And so that's a real advantage. So let's move on and talk about some of the other hidden characteristics. Let's talk about the creditor protection characteristics. Let me start by giving the standard caution that we generally give to folks who call in and ask us questions about creditor protection or asset protection. And that is that it's very hard to give straight answers with regard to asset protection characteristics. Every circumstance is different. The character of the creditor makes a difference in terms of whether or not certain assets are protected, and each state has its own rules about asset protection characteristics. So it's always right to tell your client, if your client asks a question about asset protection, to tell the client to go consult with their own attorney for an answer that they can actually rely on. And that's because it is so ambiguous and fact specific. Having said that, many of the states do provide specific asset protection rules with regard to life insurance and its cash values. For example, Florida and Arizona categorize life insurance and annuity cash values as being 100% exempt from the claims of creditors, certain kinds of creditors. If it's a creditor the client already knows about, if the creditor is a spouse or an ex-spouse, if the creditor is the IRS or another government agency, those general asset protection rules probably don't help the client. But for other creditors that the client doesn't know about today, future potential creditors, the asset protection rules may be helpful. And if state law provides extra protection for life insurance cash values, and many states do, that's something that we can certainly tout to our clients and our prospects. For a complete list, feel welcome to call. You can also consult the website creditorexemption.com for the asset protection characteristics of life insurance and annuities in each of the states. By the way, we often get asked questions about whether life insurance is a countable asset for Medicaid purposes, and it is. That's a different standard, a different question than one of asset protection. Countable assets is the standard about whether or not our clients will qualify for certain benefits, and that's why life insurance can count but also be protected from an asset protection perspective. So life insurance is definitely a countable asset for Medicaid purposes. Life insurance is advantaged for financial aid purposes. The free application for financial aid or federal student aid is one of the tools that's used to determine a student's eligibility for financial aid. The parents' assets and the student's assets count. They count based on a particular formula. And if you've got too much either income or assets, you won't qualify for financial aid for college. And so the fact that life insurance cash values don't count against financial aid is a good thing. And so it's a reasonable thing for somebody to decide to put some or all of their cash money in permanent life insurance if life insurance is needed, because life insurance has the ancillary benefit of being FAFSA advantages, if FAFSA advantaged. And so that's a good thing and kind of a hidden thing that's an advantage for life insurance. Life insurance also has potential tax-advantaged rider benefits. For example, if the life policy has a disability income rider, in most cases the income will be tax-free as a health insurance benefit to the policy owner. A critical illness rider will also generally, any benefits paid under it will also generally be tax-free to the insured taxpayer based on Code Section 105. Waiver of premium also tends to be a tax-free benefit under a life insurance policy. The circumstances will of course matter, but in general those benefits are tax-free. In addition to rider tax-free benefits, there is the ability to get the life insurance death benefit income tax-free. That's under Code Section 101. It says life insurance is usually income tax-free. There are some exceptions to that rule. For example, if a life insurance policy is transferred for valuable consideration, it's possible for our clients to screw up the income tax-free nature of the life insurance death benefit. The transfer for value rule, which is that screw-up that I mentioned, most usually comes up in a business situation. So anytime you're transferring a life insurance policy in connection with a business relationship, be aware of the potential application of the transfer for value rule. In other situations, it's easy to tout the income tax-free nature of the life insurance death proceeds. Also, one other thing that can potentially screw up the income tax-free nature of the life insurance death proceeds is the Goodman triangle. It comes up, again, mostly in business situations where the business is the owner of the life insurance policy naming a personal beneficiary. And so the case cited here is Golden versus Commissioner. That was the business case. It's also possible to create a gift tax situation in a family situation. That's the Goodman case. That's why it's also that's why this kind of triangle is referred to as the Goodman triangle. The situation is this: you've got one owner of the contract, a different beneficiary, somebody other than the owner is the beneficiary. Treat all of those situations with caution to avoid the unintentional application of either the Golden rule or the Goodman rule, creating an unexpected tax result on the death benefit. So we talked about the tax advantages of a lot of the life insurance policy riders. It's also possible to get at the death benefit early in certain circumstances, and getting at the death benefit early will be income tax free. A lot of carriers have a chronic illness acceleration of the death benefit. Code Section 101, the same code section that gives you the tax-free nature of the life insurance death benefit when it's paid on account of death, also gives the ability to get at the death benefit early to pay for chronic illness if certain standards are met. And that acceleration for paying for chronic illness is generally income tax-free. In 2007, up to $360 per day are actual long-term care expenses, whichever is greater. The insured's got to meet the statutory definition of being chronically ill in order to be able to qualify for that tax-free acceleration. Likewise, if the insured is terminally ill, a death benefit paid early to the insured because of terminal illness is also tax-free. Terminal illness means that the insured has been certified by a physician as having an illness or physical condition which can be reasonably expected to result in death within 2 years. We often get asked what happens if the insured doesn't die by the deadline. The answer is that's not a problem as long as there's been a certification that the expectation was the insured wouldn't live for more than 2 years. That acceleration of the death benefit on account of terminal illness is income tax free. Finally, we've got the ability to configure life insurance death proceeds in such a way that they're estate tax free in addition to being income tax free. How do we do that? Usually the way we do it is to make the life insurance to be owned by an irrevocable trust. We can also have people make gifts of other assets and put them in an irrevocable trust, irrevocable or irrevocable trust. And those assets would likewise get out of the taxable estate of the person who puts the stuff in the trust. But life insurance is a unique asset because you can put in a little, that's the premiums, and get a lot on the back end, that's the death benefit, even if the insured person dies quickly, right? Which is kind of unique compared to other types of assets. And so that's why putting life insurance in an irrevocable trust and getting the estate tax exclusion of the death proceeds is a consistently viable strategy. And life insurance is a source of cash at death. It's a source of income tax-free and properly configured estate tax-free cash, so the cash is available at exactly the right time to help pay for estate taxes, and that's what makes it a valuable tool for so many of our clients. Is it always right for our clients to put life insurance in an irrevocable trust? No, it isn't, because there are some give-ups. There's a give-up of control and access, but for many of our clients, it is the right approach, and that situates life insurance as a unique asset to solve certain types of problems that our clients have. So let me wrap this up quickly. Generally, we think of life insurance's biggest advantage as the income tax-free death benefit, but there are other amazing features of permanent life insurance that we've touched on today that can offer benefits while our clients are alive. And so because of those obvious and less obvious features, permanent life insurance is an amazingly versatile tool, and I think we can present it with confidence to our clients who can use its death benefit protections, but can also use those benefits that are available during lifetime. At this point, I'd like to thank you for joining our webinar today, and I'd like to turn the program back over to Jennifer Lawler, who will wrap this up. Jen?
Thanks, Linus. And thank you for joining us today. And please consider joining our future webinars on the first Wednesday of every month at 11 Central Time. As a reminder, if you would like to receive supporting materials for this webinar, feel free to email me at asktheexperts@advancedunderwriting.com. Again, that's asktheexperts@advancedunderwriting.com. You may also email questions related to today's webinar to us. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.